Learning objective number 2, there are 3 types of business activities that are identified on the statement of cash flows. We're talking about operating activities, which is about creating revenues, expenses, gains, and losses, which really results in the bottom line net income. So operating activities is related to net income. Investing activities is really related to the decrease and increase of long-term assets. So investing activities, you can think of it as a company investing in itself. It's purchasing fixed assets, property, plant, and equipment. In some cases, it's selling them as well. So it's just about the changes that occur, primarily the changes that occur in fixed assets. You can have investments in other companies as well. But for the most part, investing activities really primarily involves the purchase and sale of property, plant, and equipment. And then finally, the financing activities, those are all related to long-term liabilities and owner's equity. So we have the assets. Those assets are going to be financed one of 2 ways, either through the use of long-term liabilities or through the use of owner's equity. Here's a graphic that shows how the areas of the balance sheet impact the statement of cash flows. So, for example, on the left side, you have assets. More specifically, you have current assets. Current assets will impact operating cash flows. Long-term assets will affect investing activities. Current liabilities are going to impact operating cash flows, just like current assets affect operating cash flows. So current assets and current liabilities affect operating cash flows. And then long-term liabilities and stockholders' equity, those 2 items affect financing cash flows. There are 2 formats for the operating activities. There's the indirect method, which reconciles net income to net cash provided by operating activities. It is the most common method used by most companies. In fact, I have never come across a statement of cash flows that uses other than the indirect method. However, even though it is the most used, primarily because it is a simpler form, the method that is recommended is the direct method. And the direct method reports all cash receipts and cash payments from operating activities. Gives you a lot more detail about what's going on with cash flows. So indirect is used most commonly because it is simpler to use or prepare, and maybe even simpler to understand. The direct method is used because it provides much more detail that could be useful to the financial statement user. In the end, though, the bottom line net cash provided by operating activities will be the same. And by the way, these indirect methods and the direct method only differ in the context of operating activities. They, when you're looking at the other 2 activities, which involve investing activities and financing activities, those sections are computed in the same way. We have a template here, a template of the statement of cash flows using the indirect method. And this is a good template to refer to when you're preparing the statement of cash flows and trying to remember how you prepare it. First of all, you have the 3 sections: the cash flows from operating activities, the cash flows from investing activities, and the cash flows from financing activities. Those 3 sections are going to be presented on the financial statement. To prepare the cash flows from operating activities, you're going to start off first with net income. That's going to come from the income statement. And then from there, you're going to make adjustments to that net income. And those adjustments are going to be to reconcile net income to net cash provided by operating activities. Now you're going to have this dollar amount, this net income, and then you're going to add to that any depreciation depletion or amortization expense. These are non-cash expenses, so those expenses are embedded in the computation of net income. They are reductions, and so because they didn't affect cash flow, we need to add those back. We're going to add back any loss on the sale of long-term assets. We're going to subtract any gain on the sale of long-term assets. We're going to subtract any increase in current assets other than cash. We're going to add decreases in current assets other than cash. We're going to add increases in current liabilities, and we're going to subtract decreases in current liabilities. If you recall that slide we looked at, the slide specifically said that current assets and current liabilities affect operating activities. So those changes that occur within those areas on the balance sheet are going to impact the statement of cash flows, specifically operating activities. The next section, cash flows from investing activities. Those are going to involve the sale of long-term assets. If you have a sale, that's going to be a positive impact. A negative impact will be the purchase of long-term assets. We're going to add any collections of a note receivable, and we're going to subtract any loans to others. Those are going to be primarily the impacts associated with investing activities. The last section, cash flows from financing activities. What do we have? We have the issuance of stock that will have a positive impact to the statement of cash flows under financing activities. The sale of treasury stock are going to have a positive impact on cash. The purchase of treasury stock will have a negative impact on cash. The borrowing or issuance of notes or bonds payable, that's going to have a positive impact on cash. The payment of notes or bonds payable will have a negative impact on cash. And the payment of dividends will have a negative impact. So anytime you have a payment, you're reducing cash. Anytime you're borrowing, you're going to be receiving cash. When you're purchasing, that's a subtraction. When you're selling, you're increasing. Or if you're issuing stock, that's going to be an increase. The bottom line summaries, we're going to take the cash at the end of the prior year, which in this case is December 31st, 2017. We're going to take that number and add or subtract based upon what our cash flows, our total cash flows were for the company for that period. And then that's going to give us the cash at the end of December 31st, 2018, or the end of the period. Exhibit 11-3 gives us another slide which shows a graphic showing the positive impacts to operating activities and the negative impacts to operating activities. We went through those right now in the previous slide, but you can run through them at your leisure. We have the investing activities, cash receipts. These are going to be positive. Cash payments, those are going to be negative. And then financing activities, the positive items are going to be listed here. The issuance of stock, selling treasury stock, borrowing money, those are going to be cash receipts. Cash payments are going to be payments of dividends, purchase of treasury stock, and the payment of principal amounts of debts. These items are going to be under the financing activities.